Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, the Dividend Diplomats. All right, three more stocks. Our latest video featured three Dividend Kings. That was released on Sunday. Today, it's Tuesday. You know where to find us. We're talking to you about three other potentially undervalued dividend stocks to buy right now, everybody.
Right now, guys. Obviously, before we do, you know the drill. Smash that subscribe button. Give the video a thumbs up, guys, because we're trying to reach the millions and millions of dividend investors out there, guys. Let's pump this channel up. Let's get the people going here. Let's get to 15,000 plus subscribers. Holla at your boys.
So you want dividend stocks? We've got them for you because the S&P 500 continues to present buying opportunities for us. Isn't that right, Lanny? I mean, the market just can't catch on fire right now. It just keeps going in the other.
Catch a break. So, guys, what can you do when the stock market drops 3%? You buy more dividend stocks. Why? Because you are buying more passive forward income. What we think is the best form of income, dividend income, for less. And man, Bert, your stock watch list features some three strong stocks. Two, technically, you could almost argue are in the same industry, but don't over really lap. Yeah. But this is awesome. Great list. The one, I can't wait to hear your thoughts about them.
And the fun thing is I own all three of these companies now.
I own zero.
Yeah, you do own zero. So you're sitting on the sidelines. You're fully objective in all this. You're just looking at the metrics. You're just sitting there with your Dividend Diplomats coffee mug, sipping on some coffee, sharing your opinions about the metrics as they are presented to them. So everybody check that store below, buy a coffee mug so you can sip on some coffee while while watching our videos.
So you guys can sip on some dividend income, guys. Before we dive into the stocks, before we dive into Bert's three big dividend stock watch list here, let's look at the metrics, the Dividend Diplomat stock screener. One is that price to earnings less than the S&P 500. Two is that dividend payout ratio, the dividend income over that earnings per share, preferably below 60%. And guys, we want that history of dividend growth. We need a high growth and a lot of years of that dividend income stream pumping up.
That's right. And then we'll look at the dividend yield at the end of it after we look at those first three metrics. So first up on the list, this is a stock we started building a couple of years ago. It's been funny. It's gone through two up and down cycles since we bought them. And it's funny because we bought them around this price. They shot up. We stopped buying them, came back down. We started buying them again, shot back up again. So we stopped buying them. And here we are at that same level again. So I'm going to take this chance to continue building our position, most likely, especially after we look at the metrics here in Qualcomm, ticker symbol QCOM.
Guys, Qualcomm, what a dividend stock here. This has become a beauty dividend stock almost right now. And wow, these metrics are pretty wild. Trading at $128.48 as of September 2nd's close. That forward EPS is $12.98. That price to earnings ratio, that first Dividend Diplomat stock screening metric, the price to earnings ratio is only 9.9.
Exactly. Let's look at that second metric. Their annual dividend is $3 per share. Divide that by the forward earnings of $12.98. That gives you a payout ratio of 23.11%. Yeah. And I mean, for a tech company, you typically want a lower payout ratio because they need a lot of capital to keep reinvesting in the business to keep up with their competition. So 23% is exactly what I want to see in this sector.
And guys, let's get into that dividend growth. They're now over double-digit years growing that dividend income stream. They're at 11 years, and they're doing it at an average dividend growth rate of 5.4%, which some could argue that growth rate could be a little bit higher.
I would agree at that point. I think that's a fair point and a fair knock potentially for Qualcomm. Let's look at the yield, though. Their yield at the moment is 2.33% after their stock price has fallen. So a nice premium compared to the S&P 500.
Cue the Alicia Keys music. Fallen, guys. Price to earnings at a 9.9. Payout ratio 23%. Record of dividend growth, double-digit years, doing it at 5.4% on average, and a yield above the S&P 500 at 2.3. 3%.
So at the moment, my wife and I own 8.074 shares due to some dividend reinvestment. That's why I'm thinking this is going to be a good chance to possibly pick up, at least in the short term, get it to 10 shares, maybe with a longer term goal of at least 20 for Qualcomm.
Guys, let us know in the comments if you, if you've got some shares of Qualcomm.
Yeah, keep us updated. Let's move into that second stock here. This one probably shouldn't surprise very many of you. I said I own the companies that we're talking about today, but this is the newest company that I own. Just initiated this company position in this company after one of our videos last week, which will give you a lot more detail to why I ended up buying this stock there. This company is Texas Instruments, ticker symbol TX.
Texas Instruments, man, it is back here on another video here. Bert featured it. If you haven't caught it on last Thursday's video on September 1st, the first of the month, wake up, Bone Thugs, baby. But man, Bert, this stock price has continued to fall, I think, since the release of that video.
Yeah, it was about in the 166, 167 range for the video. Now it's trading at 163. So it's coming down a little bit.
It's coming down. What goes up must come down. And that's what's happening with this great dividend stock, Bert.
So let's run through the metrics here. Price 163, divide that by forward EPS of 958, a PE ratio of 17. So it's clearly, we talked about this in the video. It's not the cheapest of stocks in the tech sector. It's probably never going to be. It's almost double what Qualcomm's PE ratio is. It's more than double what Intel's PE ratio is at the moment. So it's not the cheapest, but that's not necessarily a bad thing. Quality isn't always going to be cheap. You saw that in our video on Sunday too, when we talked about Procter and Gamble, and we talked about quality. Yeah, the crappiest of all of the Pokemon out there, Magikarp. The card's great though. Card's great. They're not talking about that. Quality isn't always going to be cheap. So a 17 PE ratio discount compared to the S&P 500, still showing signs of undervaluation there for Texas Instruments.
Guys, wow, payout ratio right now, they pay a nice dividend. Over the course of the year, it's $4.60. Obviously, when you do the math, that's $1.15 per share per quarter. Dividend payout ratio right now is only 48%, in that perfect sweet spot between 40 and 60%, safe, and the ability to keep juicing that dividend.
They've increased their dividend for 18 years. Their 5-year dividend growth rate is 18.13% on average, which is absolutely insane.
I love that. They're getting closer and closer to the aristocrat status, and they will get there. Now, Bert, now that the price has finally dropped on that bonus metric, that dividend yield, you're getting closer to that 3%, man. Let's go. It's at 2.82%, higher than your favorite stock, J&J, which is 2.78. So it's funny to see who's going to get to 3% first here. Come on.
Yeah, hopefully both. That's the outcome. They both grab the belt at the same time when they climb up the ladder. And they're just dangling and they're hanging. I'm like, yes, keep going.
And spear both of them down to the mat.
Hey, that works. That means there's going to be another undervalued stock that's going to spear them both from there. So after that, we'll just summarize it. 17 PE ratio, 48% payout ratio, 18% 5-year average growth rate, 18 years of consecutive dividend increases with a yield of 2.82%. And they have a dividend increase coming here in September.
Let's go. Let's go, guys. Bert, you've got to do the honor here on this third dividend growth stock.
Yeah, Stanley Black & Decker. Let's just jump right into it. It hasn't been a great year for Stanley Black & Decker, down 53% year to date, down 55% over the last 52 weeks. They rode the DIY boom up, and they are riding it down too. The stock just can't catch a break. Last month after earnings, they slashed the you-know-what out of their forward guidance. So, and with that, the price came tumbling, demand came down. They're getting hit with supply chain issues. That being said, we started building the position at 130. Our average was at about $110. Now it's climbing down as we keep nibbling and adding 1 or 2 shares at these lower prices to help drop the cost basis down in this dividend king.
I mean, it's a dividend king, guys. They've been through problematic financial crisis time periods. You think about over the last 54 years, dating back to 1968. Think about all the turbulence, the oil crisis during the 70s, the S&L crisis, 80s, 90s, the tech bust, the housing, the financial crisis. Do I need to keep going? The pandemic. Now we're in a possible recession here, guys. Stanley Black & Decker is like, we got the tools, no pun intended, built to get through this.
That's right. So with that, their price has just gone tumbling down. They were hanging around 100 after their earnings release, and it's just been a couple of these
people's elbows.
Yeah, well, they were the ones that were laying on the mat getting the people's elbow, because their price right now is at 85.77. So I'm looking at this and I'm like, every once in a while picking up a share or two isn't going to hurt right now. I'm already in this company. We already own 25 shares of Stanley Black & Decker.
Deep in this company.
Yeah, one or two, maybe getting up to 30.
5K.
Yeah, well, maybe getting up to 30 shares and getting those extra 5 shares when the price is in the 80s is kind of where my mindset is, to help drive that cost basis down even further. So the question is, though, let's now look at their metrics. Now that their price is falling, they downward adjusted that EPS. With that lower EPS, are they still a value? We're going to answer that question right now.
All right, that first metric, price to earnings, expectation $7 in EPS. Right now, that price to earnings at $85.77 share price, taken share price divided by that $7.07, a 12.13 price to earnings ratio.
All right, so pricing now is still a discount compared to the market. I like it. Their annual dividend is $3.20 after that pathetic dividend increase that they announced in June. Payout ratio, interestingly, is still 45% for them, which is what I want to see.
Keeping it safe, trying to do what they can do to protect their cash flow.
Yeah, exactly right. We mentioned they're Dividend King. They've increased for 54 years. 5-year dividend growth rate is 6.06%, which is obviously weighted towards the front end of that 5-year window.
So guys, I mean, right now, if you want to get the financial freedom, this could be a great stock to buy right now. Stanley Black & Decker long-term stock is, that dividend growth rate at 6% for 54 years, and the bonus metric of a dividend yield of 3.73%, Bert.
Yeah,
nice.
When we started our purchase, I thought we were getting a steal getting Stanley Black & Decker at a 3% yield. Now it's at 3.73%.
Now the question is this stock has been beaten up 54%. It's the horse that fell, and then everybody else kicking it in the stomach. So what is your thought? What are your thoughts now on these 3 stocks? We'll show the metrics here on the screen, but break it down for me, Bert.
Yeah, I mean, I mentioned Qualcomm. I want to at least get to 10 shares, so that's 2 more shares. Texas Instruments, in our last video, I mentioned we own 3 shares now after we started the position. In the long term, I want to build up to 20 shares of Texas Instruments at a minimum. Stanley Black & Decker at 25 shares. I want to at least try to get to 30 shares and take advantage of some of these prices. So in the month of September, I don't know when I'm going to buy them, what the particular order is on what any given day could happen, but I can easily see myself buying each one of these 3 companies, maybe jumping in the tech sector first and then coming back to Stanley Black & Decker, because I don't see Stanley Black & Decker's price changing anytime soon.
Now the question is, do you own Delta stock still?
I do, unfortunately. So, I mean, I've also talked about shedding some of those smaller positions in some of the positions I own and moving them into a company like Texas Instruments, moving them into the tech sector. So it's an option too.
Interesting. I know.
Shed some losers.
I know you talked a little bit about Oxy.
I was getting ready to sell Oxy. I was getting ready to make the move, and then the price just flew down. So,
did it?
Yeah, but keeping an eye on it, everybody. So I'll keep you updated. So keep an eye on our Twitter feed. Keep an eye on the YouTube community posts.
So guys, let us know. Do you think these are stocks to buy right now in September 2022? If you're a beginner investor, do you have your eyes set on Stanley Black & Decker being a dividend king over 50 years of increases, being a college student using Texas Instruments as part of your TI-83 calculator? Are you going to buy a share or 2 right now?
Yeah, if you haven't already, subscribe to the channel. Give this video a nice big old-fashioned thumbs up, everybody. We appreciate the support and our journey to 15K, 16K, 17K plus subscribers.
Let's go. Let's make it happen. Keep pursuing financial freedom. Build that passive income stream. That's Bert and Lanny from the Dividend Diplomats. Over and out.